All right. Hey there, everybody. Thank you so much for joining us today. We're going to try something a little bit different today. We're doing just simply really kind of a Q&A session for our self-directed clients. My name is Sean McKay, and this is an American IRA presentation. And so we thought it'd be kind of fun to just kind of open it up, see what sort of self-directed IRA and 401k questions you guys had out there, and really just kind of give an open platform for those that have kind of specific situations or questions that maybe we don't address when we do our typical webinars. And so we did blast that out to our list. Thank you for those of you that sent in questions. We got a ton of questions. And so we'll be able to drill into that, and we'll do this for a bit today and see how it goes. And so certainly a lot of the questions we get do revolve around kind of the business model and the fees. So I figured I'd just kind of proactively address some of those concepts with a slide or two here. And then again, we'll go into some of the questions that have been already sent in. And certainly for those of you listening to us live, feel free to type into the questions box, and we'll be trying to get through as many of those as we can today as well. So at American IRA, we are a fully integrated self-directed provider, meaning that we have the same ownership group for the administration company, American IRA, as we do for our parent custodian, which is New Vision Trust. So a lot of times we get the question about, are you an administrator or a custodian? And so essentially we are both. And so really that's kind of the ideal answer, if you will, as it pertains to the business model for the self-directed IRA company. We are located, our headquarters is in Asheville, North Carolina. We have a satellite office in Charlotte, North Carolina that we're kind of starting the process of upfitting, working through kind of the reno for that office. So that's a little bit of a process these days, but it's going to turn out great. So in terms of where our clients are located and where they can invest. So we have clients nationwide. We do also have clients that live internationally, and they are certainly able to invest nationwide in the States. And from time to time, clients will also investigate investments that are international as well, especially as it pertains to international ownership of real estate. So that certainly can be a part of your portfolio as well. And so as with any self-directed provider, really our role is to do essentially the record keeping for your IRA. And so ultimately we are not advisors that are going to be picking products for you. So if you come to us and you say, can you identify a great piece of real estate for me to buy with my retirement account? Unfortunately, we are not licensed to give advice. So whether it's leaning on real estate professionals like realtors, appraisers, maybe real estate investors. Perhaps you want to get some ideas from your financial advisor, CPAs, attorneys, etc. Those can be helpful resources. We have to kind of stay in our lane, if you will, as it pertains to these self-directed accounts. The other question we get a lot is about our fee structure, and I do have a few of those questions that have been sent in, and we'll address those. But so I won't read this slide. I'll let you look at this at your leisure, but really the way the annual fee is constructed is very different than what you find largely in the self-directed space. So typically what you find is that the annual fee is either based on the value of the account or it's based on the number of assets inside of the account. So with value of the account, certainly as the account gets larger, your annual fee increases as well. With the number of assets model, usually it's about $300 per year per asset. So very obviously simple math there. So if you have 3 assets, for example, you're going to be looking at about $900 from an annual fee perspective. So with our model, the way we do it is there's simply one breakpoint for the value of the IRA. So if your account value at the time that you make your first investment is less than $7,500, your annual fee is $165 a year. $7,500 plus, your annual fee is $285 a year. So that could be a $10,000 account, that could be a $10 million account. That can be one asset, that can be 30 assets. The annual fee is $285 a year. Now, in addition to that, most self-directed providers do also have a transactional element. There's a fee if you purchase an asset or if you sell an asset. And so the way our transaction fee works is the single transaction. So let's just say one purchase of an asset. Let's say it's going to be a long-term asset for you. A single purchase is $95. Now you can do unlimited transactions, so it's the unlimited purchase or sale of assets for $165 a year. So that gives you kind of an understanding of what those fees look like. In addition to that, again, you're typically going to have bank fees associated with your self-directed account. So at American IRA, that is a $10 check fee for outgoing checks. For wires is a $30 wire fee, whether it's incoming or outgoing wires. Now, for those of you that are interested in the solo 401k product, because there is a 401k plan attached to it, it is an additional $300 a year. So instead of the annual fee being $285 a year, the annual fee for a solo K is $585 a year. So again, hopefully that helps you out there. Now, the other thing that I'll tell you is that in terms of the timing for your annual fee, most self-directed providers are going to charge you the annual fee when you establish the account, or usually the first quarter of the calendar year. For our IRAs, the annual fee does not kick in until you make your first investment. So for example, you might open and fund your account in April of 2021, but you may not make an investment until November of 2021. So November is when the annual fee kicks in, and so your anniversary date will be November for your IRA. Conversely, with your solo 401k, there's a lot more work that is done by our processing team. So the annual fee will kick in when you establish that solo 401k, not when you make your first investment. So hopefully, again, that brings a little bit of clarity to what the fees look like in terms of the self-directed IRA fees. So we're going to go ahead and just dig right into it. We'll go ahead and open up, again, the questions box if anyone listening live has any questions. And we'll go ahead and also just dig into the questions that have already been sent in. So this is really going to be kind of a potpourri of questions. So apologies that they're not kind of linear, if you will, in terms of the thought process. This is coming from dozens and dozens of different investors and clients. So first question is, if you buy tax liens, does the money grow tax-free? So the answer to that is, it depends on the type of retirement account that owns the asset. So if you have a post-tax account, such as a Roth IRA or a solo 401k that has the Roth component, then that would be tax-free growth. If it is a pre-tax account, such as basically any other type of account, a pre-tax 401k, a traditional IRA, a SEP, a simple, those will be tax-deferred gains on the account. So you're going to be taxed when you take money out of your retirement account in your retirement years, hopefully after 59 and a half. So the next one is, what happens if the individual with the tax debt cannot pay the bills? And so this revolves around the idea, I presume, of if somebody has a scenario where, let's say they're doing a Roth conversion. So let's say that if someone has a pre-tax vehicle like a traditional IRA and they are going to convert it to a Roth IRA, is there a tax? There's going to be a tax consequence who pays that tax bill. That can be paid either from the retirement account or from the individual's funds. You would need to pay that tax consequence. That's critical because you're going from pre to post tax. So that can be paid from either vehicle if the tax consequence is constructed based on that Roth conversion there. Are investments into metals delivered to the IRA owner or to a custodian only? So that's a really good question around precious metals. So the idea there is that an investor is looking to purchase something like gold or silver, so the physical metals. So they need to be stored somewhere. So the critical thing is that the precious metals would need to be stored at a third-party location that will not be American IRA as the self-directed provider. That will be a third party. Typically, it will be at a depository. Many times, a depository is also a broker where you can purchase the precious metals. If not, the broker that sold the precious metals to your retirement account will certainly have a relationship with a depository that can store those metals on behalf of your retirement account. But unfortunately, you as the account holder cannot store those metals. All right, so the next question is, can the husband's and the wife's self-directed IRA purchase a single real estate property? So we're looking at essentially a partnership arrangement between a husband's IRA and a wife's IRA. Can they partner together on the deal? So yes, they can partner together on the deal as long as it is on the initial acquisition of the asset. They're going to determine what percentage of ownership the husband's IRA has and what percentage of ownership the wife's IRA has. That will not change throughout the years. It has to stay directly in that manner. So it could be the husband owns 40% through his IRA, the wife owns 60%, or it could be 70-30, 50-50, 80-20, whatever makes sense for those two retirement accounts. And really that will be predicated on the money they have available to some extent for the account. So in other words, the husband, if it's 40-60, 40% for the husband will need to be able to bring 40% of the capital, not only for the purchase, for the rehab, for any sort of holding costs, and also gets 40% of the income on the back end. So the next question is, can you use your IRA as an investment right away, or do you have to wait, and for how long? So, excuse me. So that's actually not a question we get very often, but it's an interesting one. So there is technically a 7-day right of rescission on the retirement account. So really what that means is in the first 7 days of existence, the retirement account must stay frozen. It cannot make an investment. Typically, that's a complete non-issue because during that period from when the account is established, we're working with your current custodian to get monies moved over to us. But again, keep in mind that 7-day period is in existence. So from when we receive the paperwork, 7 calendar days, during that period of time, the investment will not be made. All right, so the next one is it better to start with a traditional IRA or Roth? Can you have both and transfer into the other? So in a nutshell, we always want to rely on our tax professionals to give us guidance based on our situation. So I cannot speak to any particular individual, nor am I licensed to. What you do here in terms of, we'll just talk macro theory about investment structuring, is that all things being equal, many tax professionals do like the idea of a post-tax retirement account if you're just simply starting a new IRA, because again, with the Roths, you're going to get tax-free growth. With the traditional IRA, you're going to get tax-deferred growth. So for example, if you end up growing your retirement account to $500,000, at the time of retirement, you would far rather have those monies in a Roth IRA because you can pull that money out and not pay taxes as you take possession of those monies. Conversely, with the traditional IRA, if you decide one year to pull out $50,000 from your traditional, that $50,000 is counted as income, and you'll pay a tax consequence for whatever your tax ratio is, your tax rate is for your personal taxes for that year. So if you're in, let's say, kind of a blended rate of 25%, then 25% of that 50K is going to end up going to Uncle Sam, essentially. Now, you can have both a traditional and a Roth. You can do a Roth conversion from a traditional IRA to a Roth IRA. I've yet to see a scenario where someone wants to go from a Roth IRA to a traditional IRA. The only time that will happen is if essentially they were not eligible to directly contribute to a Roth, and they have to do what we call a recharacterization, put the monies initially into a traditional IRA, and then at some point in time they can always do a Roth conversion. Everyone is eligible for a Roth conversion. Not everyone is eligible to directly contribute to a Roth. So just a little food for thought there. So the next one is, when is the annual fee due? Are there any fees associated with the account? So again, with the annual fee for the IRAs, the annual fee is due in the month you make your first investment. With the solo 401k, it is due in the month that your account is established. The other fees revolve around the transaction fees we spoke about. $95 for a single transaction, $165 for unlimited transactions, bank fees, $10 outgoing check fee, $30 wires. Okay, so the next one is, if I want checkbook control for a fix and flip scenario, do I need to open a specific type of account? So there's a couple of moving parts here. So part one is, you're going to open a retirement account and you're going to identify the type of retirement account you have. So if it's an existing retirement account, you'll typically open the same type. So if you currently have a traditional IRA, you'll open a traditional IRA most of the time with our firm. So your account has been established. The next step, we're talking about checkbook control. So that's a retirement account owned LLC. So your retirement account needs to form a very specific type of LLC. The retirement account becomes the member. There will be a individual that is the manager for that retirement LLC, and then the LLC will then go on to make the investment of, in this case, a fix and flip property. So there's really kind of 3 layers to go through. So you're picking your retirement account, you're identifying whether you want checkbook control or not, and then the end investment is fix and flip. So any of those types of retirement accounts can have the checkbook control, and they can do fix and flip real estate deals. So the next question is, if I have real estate rentals, can I take part of the money out? So if the retirement account is the sole owner of the property, the retirement account must receive all of the rental income from that asset. Now, you can choose to take a distribution from the funds once they come to the retirement account. And so that is obviously just personal preference, and depending upon your age and situation, that may or may not be appropriate. You can partner with your retirement account. So again, that joint venture idea where you or your LLC own a portion of the rental, your retirement account own a portion of the rental, and that's identified and determined before you make the acquisition of the rental property. And then in that scenario, if you personally own 20% of that rental, then you would receive 20% of the net income. All right, so next one is, when you are 59 and a half, can you start taking part of the money out in small portions? So yes, 59 and a half, that's kind of that's an important age in terms of retirement accounts and being able to take those distributions without 10% penalty. And then again, depending upon the type of account, post-tax accounts like a Roth IRA, you can take the money out tax-free, assuming you've had the account for at least 5 years. With our pre-taxed accounts, you can also take the money out at 59 and a half. The amount that you take out will be taxable income to you. So the next question is a great one. It says, what happens if I unknowingly engage in a prohibited transaction? So the short answer is there's a number of potential outcomes there. The prudent thing to do is to immediately make especially your CPA aware of this mistake. Unknowingly engage in a prohibited transaction. So unknowingly is a key component there. What we've found historically is, in the industry, if a self-directed investor unknowingly creates a prohibited transaction, then that's a scenario where we've actually found the IRS to be pretty reasonable in giving them guidance as to how to unwind that investment. Usually kind of the penalties around that have not been particularly stiff or severe, But again, the key is to make your tax preparer, your CPA, aware as soon as possible so that they can give you guidance as to how to move forward. So the next question is an IRA protected against fraud? So the most typical type of fraudulent activity you'll see in the investment arena is working with entrepreneurs, with business owners, with different types of groups that are engaged in some sort of financial services that are deliberately involved in some sort of fraudulent activity, whether it's a Ponzi scheme or some sort of, again, this isn't an unknowing prohibited transaction. They are deliberately duping investors. And so is an IRA protected against that? So from the standpoint of can an IRA or 401k invest into a fraudulent investment? Unfortunately, it can, just as any investor can. So a retirement account can invest in a Ponzi scheme. So certainly we want to do as much due diligence as we can, bring in third-party resources to help us vet those opportunities. So it can invest into a fraudulent investment. So the next question is, if I open an IRA, when do I need to fund my account? Can I wait until I find an investment? So that's certainly a very necessary question and something we want to be clear on. And so the reality is that when you establish the account, you should be prepared for at least a partial funding. Now, a partial funding could be as little as a few $1,000s, just so that it is an active retirement account. So we will require there to be some initial monies put into the account. However, if you're unsure of the scale of the investment that you're looking to make, and you're looking to move over additional monies prior to a specific investment being made, that's certainly something that you can do. So open the account with the intention to put at least a few $1,000s in as an initial funding. You can always move over additional monies later. The next question is, can I have more than one rental property in an IRA? Yes, you can. So we have some clients that have countless, just dozens and dozens of properties inside of an IRA. At a certain point, however, their professionals will say it's probably prudent to have multiple retirement accounts set up to house these assets, and that's kind of a whole big discussion in itself. But yes, your retirement account, your IRA or 401k can certainly hold more than one rental property. All right, can an IRA owned LLC do a JVA with a personal LLC? So can an IRA owned LLC do a joint venture with a personal LLC? So yes, again, the key is that's so critical before the investment is made to determine the ownership interest between those two parties, the retirement account owned LLC and the personal LLC. Can we go into a loan/investment with both my IRA and personal funds so that I can personally interact with the investment/loan? So I'm going to take this from the perspective of, let's say that you want to partner with your retirement account on a fix and flip, a real estate deal, so that if you personally own 50% of this property, your goal is to be able to do 50% of the sweat equity on the project. Unfortunately, if your retirement account owns really any portion of that rental property, you should not provide any personal services. So you should get third-party contractors, handymen, etc. to do the work. All right. How can I lend money to my son's LLC for a rehab or new build with my self-directed IRA? So I love to learn from creative real estate investors and entrepreneurs as it pertains to essentially getting money to your son's LLC, business, whatever the case may be. There's not a legal way to structure this. I'm sure we have clients that have gone above and beyond to be creative. They've moved monies to third parties so that those third parties could end up lending money to, in this case, the son's LLC. That's what we consider a step transaction, where we're doing something indirectly that we could not do directly. So you cannot legally make that work, unfortunately. is there a time limit that the loan must be paid back? So there is not a time limit for kind of the wrapping up, if you will, of the loan. So a loan can be out for 10 years, 30 years, 50 years, etc. But the key is that there needs to be payments made. There needs to be at least one payment made in the first 12 months. And that's really guidance we've gotten from state regulatory resources, if you will, with the banking commission, letting us know that from their perspective, a loan would be considered active if there is at least one payment made in the first 12 months. But the length of the loan, again, can be decades and decades. So the next one is kind of an interesting question where it says, is there a cap on how much interest I can charge? So really the critical determination when you're making a loan, when your IRA or 401k is the lender, is who are you lending to? So if you're lending to a person, there are definitely a lot of rules around consumer protection and what is an appropriate amount of interest to be charged. If you're lending to companies, there's typically far more flexibility. Most of the time, the rates are actually determined on the state level. So for example, kind of usury laws and the maximum interest that can be charged will differ from state to state. So it's critical to bring your attorney into play. There's some states like North Carolina where to me it's not nearly as cut and dry as other states in terms of what's the max interest that can be charged for interest and things of that nature. So attorneys are going to be very helpful in that way. If you purchase using your IRA for the down payment coupled with a hard money lender or conventional loan, does that cash flow back into the IRA or directly to me? So the first thing to be aware of is we'll assume that the IRA is going to be the sole owner of this property. So if the IRA is getting a loan, it needs to be a very specific type of loan called a non-recourse loan. So you're not personally guaranteeing it. It's really just a collateral-based loan. In that scenario where the retirement account is going to get the loan, that means that all of the cash flow will directly flow back to the IRA because it is the sole owner of that asset. All right. If you are flipping houses, can a high number of flips in a single year make you susceptible to being taxed as a business rather than an investor? So the short answer is yes. The tough question to answer is what is the number? And so what the example I always like to use is if you line up 20 different CPAs, you're going to get 20 different perspectives on how many flips they want their clients doing before they consider it a quote-unquote business, in which case at that point they are going to be considering it a business activity and attach a tax consequence called UBIT to it, unrelated business income tax. So please make sure that you are working closely with your CPA to get their guidance as to what's appropriate. All right, so the next question is, can you use your self-directed IRA or 401k to invest in real estate crowdfunding? What if the crowdfunding also is acquiring the property with seller carry financing? So good question there. So yes, your self-directed IRA or 401k can invest into a crowdfunding deal. So certainly there's kind of a few flavors of how that plays out. That could be a scenario where it's on a kind of a online portal. It's on some platform that is a third party that is kind of the nucleus for where this crowdfunding works for the entrepreneurs and for their passive investors. So self-directed accounts can engage in those platforms. In terms of the structuring of the debt, if it is a seller carry financing, so it's seller financed, the seller's carrying back a mortgage on the property, that's certainly fine. Really the key on the debt instruments is making sure it is non-recourse to the retirement account. So they cannot sue the retirement account if essentially that project falls apart and the investors are unable to perform. So that's really the critical piece there. Thank you for that question. I appreciate it. All right. Let's see. The next one is, can you take a loan if you are trying to buy an asset from a self-directed IRA? So different twist on that. So this isn't the retirement account getting a loan. This is somebody buying a property from a self-directed IRA, and can that investor get a loan? So yes, if you are just an individual or an LLC and you're buying a property from a self-directed IRA, that does not have to be a cash transaction. What methods do you use to find landlords that could be prospective sellers? So everyone has a different preference on this. I think certainly in at least what seems to be in almost every metro area of really hot real estate market, you have to kind of look at any and all options for sourcing deals. So you can look at anything from working with wholesalers to networking in your local real estate investment community. We do some content around this. I'm a big believer in getting a very, very narrow focus on what you're looking for. So you're the go-to person for duplexes in a certain part of town, or you're a go-to person for a certain style of house, whether it's brick or vinyl or houses that were built during a certain time period, or even just simply a specific neighborhood. The more granular you can get in your focus, the more people will think of you for that opportunity. Of course, there's always, just simply, there's a lot of tools out there now for skip tracing sellers that look like they might be in distress. So there's an entire industry built around that. But again, I go back to being as laser focused as possible. Can you put money in someone else's self-directed IRA? So let's say that it's a husband and wife, for example, and they are married filing jointly on their tax returns, and the husband makes a pretty reasonable salary and certainly has enough earned income to dictate that not only can his IRA make a contribution, but he could contribute to his wife that is temporarily out of work. Let's say she was laid off due to COVID, or she's working from home, she's with the kids, so she's not working W-2 or 1099. So that is a scenario where, as long as his income dictates that he could make contributions to both of their retirement accounts, that's certainly acceptable. Essentially, if it's somebody who has, outside of a spousal relationship, somebody who has earned income, you can see children, for example, that have a part-time job, and so they'll have the appropriate level of earned income, and so parents will make a contribution to that account on their behalf. So that is certainly allowed as well. What is the process to open an account, and how long does it take? So the process is very simple. We have a nice, clean little application kit that can be submitted along with a copy of your driver's license. That can be done, assuming that all paperwork is accurate and complete. That can be opened essentially within about a business day. Your account is opened. Can you invest in Section 8 properties with a self-directed account? So yes, you can. So because you're making purely an investment, so you're presumably buying a rental property that will be rented to a Section 8 tenant. Section 8 is just a government program that subsidizes a portion of rent for their tenants that work in that program. And so with that, yes, retirement accounts can, excuse me, rent to Section 8 tenants. Excuse me. All right, so the next one is, if all cash is in the IRA, then how fast can I close? So assuming the account is opened and funded, really it's going to be predicated on that closing attorney processing that. They're certainly going to have to get a title report. There's going to be closing documents that are going to be generated. Typically, about the quickest process I've seen is about a week for attorneys to kind of get through their entire A to Z process there. So we need to have the documents so that we can sign on behalf of the retirement account, everything from the offer to purchase to the closing documents. So we'll need the closing document kit 48 hours prior to closing to be able to sign that around. All right. How are the property management bills, and property taxes paid. So when a rental property is producing income, then the property manager is going to collect the gross rent. So let's say the rent is $1,000. And let's say out of that, they're going to take 8% for their property management fee. So they will take that right off the top. So they will take, in that case, $80. And so they will send, if there's no other bills associated with the property for that month, they will send the $920 to your self-directed account. As far as property taxes go, you do have some options. Typically that's paid just annually for most municipalities. You can either have the office cut a check to the municipality for the property taxes, or some property managers will cut those checks as well. Presumably that will mean that they'll have to keep more of the cash in reserves that the rental property is producing so that they can pay those kind of larger bills that come around once a year. So in that scenario, basically the short answer is American IRA can pay those on behalf of the retirement account, the property tax bills, or you can have your property manager pay that. All right, what would be the process for a non-recourse loan path? So with a non-recourse lender, certainly the first step is identifying a lender that has a non-recourse loan product. Again, no personal guarantees there. So once you kind of go through your Google searches, you identify the right fit. Just like with any loan process, they're going to kind of have a scope of work essentially that needs to be done so that they can underwrite the deal to see if it's something that fits into their metric and something that they will be willing to fund. Non-recourse lenders are kind of few and far between. It is a kind of a atypical loan product, so to get that loan closed is taking much closer what we're seeing to the 45-60 day window versus a quicker closing. So just kind of keep that in mind. All right, so next question is, how do I contribute to an IRA? So you can either send in a personal check to the Asheville headquarters, you can have an ACH done, you can wire funds. Those are kind of the typical structures for making an annual contribution. Can I contribute to more than one IRA or plan? So yes, you can. Certainly as it pertains to the IRA world, you cannot make a double contribution. And by that, what I mean is if you are under 50 years old, you can contribute up to $6,000 to either a traditional or a Roth. So you would not be able to contribute $6,000 to a Roth with Vanguard and then another $6,000 to American IRA for the same calendar year. You can have accounts at both of those firms, but the total contribution would need to be $6,000 or under. Does a solo 401k allow for Roth contributions? So yes, they do. On the employee deferral section, there is the ability to make either pre-tax like a traditional or post-tax like a Roth contribution. So just depending upon your goals and preference there. All right, so what is the difference between a solo 401k and a SEP IRA? Why choose one versus the other? So all things being equal, I think it's difficult to argue that a SEP IRA is a better investment tool than a solo 401k. They have, for individuals under 50, they have the same contribution limit. There's not a catch-up provision for the SEP as there is for the solo case. So as far as contributions go, we'll say for the purposes of just the initial analysis, they are equivalent. Where the solo 401k is going to have, well, here's what I'll say. The solo 401k is for an individual that's self-employed and does not have full-time employees. And so if you do not fit that criteria, unfortunately, you would not be eligible for a solo 401k. So if you have full-time employees other than a spouse, largely you're going to be relegated to a SEP IRA, which is a great product. Where the solo K is going to have benefits over the SEP is for those that want to borrow personally from their retirement account. A solo 401k allows that. A SEP IRA and excuse me, all of the IRAs fall into the same category of not allowing personal loans. The other benefits with a solo K is that you can make your maximum contribution with less earned income for the year based upon the way that the contributions are structured. So it allows you to max out contributions with less earned income. Excuse me. And then the final point I would make is that with a solo 401k, if you are going to use a leverage inside the retirement account, so a rental property is going to be purchased using a loan inside the retirement account, a solo K is a more tax efficient vehicle than a SEP IRA. So again, SEP IRAs are great vehicles for a small business owner that want to make higher contribution limits than a traditional or Roth. But if you're eligible for both a solo K and a SEP IRA, a solo K is going to be a better vehicle for you. All right. In the investment property, can a relative live in the property with or without rent? So there's a list of what we call disqualified persons and entities. Those are individuals that would not be able to rent the property from your retirement account, whether they're paying fair market rent, no rent, etc. So it's basically you as the account holder, your spouse, and your lineal family members, your parents, your grandparents, your great-grandparents, your children, grandchildren, great-grandchildren. The downline also includes spouses, so your child's spouse, grandchild's spouse, etc. So those individuals could not live in the property, nor could anyone that's deemed to have a significant business relationship with you. So let's say that you and your sister own a bakery together, then presumably your CPA would say you guys have a significant business relationship. And so in that scenario, you would definitely not want to rent a house to your sister. Can I sell a property and do owner financing with my self-directed IRA property? So yes, your retirement account could sell a property, kind of back to the carryback question we got, and your retirement account could carry back financing. So someone could say, I'll give you a down payment, and then if you'll let me make you payments on a monthly basis for the next X amount of years, that would be great. If that's agreeable for you, you can do that. Can a realtor list the property without taking a commission, only paying the buyer's agent? So as long as the realtor is not a disqualified person, then they can list the property without taking a commission. All right. Can you do this? So the example is the 70-30 contract strategy with 70% IRA and 30% of your own cash. So yes, if the IRA is going to bring 70% of the cash and you're personally going to bring 30% of the cash, you can do a 70-30 split. Can any disqualified people partner with your IRA? Yes, if it's at the initial acquisition of the asset, disqualified individuals can partner together. Can you use personal funds for expenses, or does it have to come from the IRA? So if your IRA is the sole owner of the property, then the IRA must pay any and all expenses. The only ability you would have to infuse money into the deal is if you are eligible to make an annual contribution to your IRA, and then those funds could then be used to supplement any sort of costs associated with the property. All right. If I lend to someone who is not a disqualified person, but they are a good friend or acquaintance, do I have the right to discount their interest rate? So again, always prudent to speak with your attorneys and CPAs about deal structure. As a general note, as long as it's in the realm of reasonable, you're usually going to be in good shape. So unreasonable, I would say, is we've had investors that want to make a 0% loan to a third party. That does not seem like a rational thing that an investor would do. So when you put money out on the street and you say, I'm going to lend you $50,000, and the best case scenario is at some point in the future, you're going to give me my $50,000 back, that doesn't strike most people as a arm's length transaction that a investor would make with just a third party individual. It seems like there's something else going on in the background. So if by discount you mean instead of I typically charge 10% interest and I would charge my friends 7% interest, I don't believe the IRS is going to have an issue with that. What if my IRA wants to buy from a wholesaler? Is that possible? Yes, your IRA can buy from wholesalers, from sellers. They can buy on-market deals, off-market deals. All of those tools are at your disposal. So next one is, by your opinion, wholesaling technique is only limited to the off-market deals. Can it include MLS too? So on-market deals. So yes, it technically can. From time to time, you'll see a property listed with a realtor where the listing is being initiated by someone who does not yet own the property. Historically, that does tend to upset the current owner of the property that their house is being marketed on the MLS. Usually that is not something that they're going to be okay with. So I would seek some guidance before doing that. But that is something that could perhaps be accomplished. So we'll end with this one. And so this question is, historically speaking, what might be considered some of the safer asset classes you have seen your clients invest in? So again, we are not investment advisors, so I'm not going to say you should have a chunk of your money in X asset. What I will say, however, is this, that when I look at our clients' individual portfolios, when I look at kind of the portfolios that we administer in aggregate, you do find that there are some pretty striking common themes that we see throughout the years. I've been in this business since 2008, so this is something I'm saying with a fair amount of historical data. I find that there are kind of two areas where investors will get into trouble. So the first one is investing into what I think most people would consider some of the more riskier, just general assets. So unsecured notes come to mind. So when you're making a loan to someone and they're just signing a promissory note, there's no actual collateral attached to the loan that you're making. So there's no business equipment with a UCC1 agreement. There's no mortgage attached to the property. That historically does not bode well for clients. And what's interesting is someone will hear just kind of a general presentation I've done, and they'll come up to me afterwards and they'll say, I'm about to make a loan to my cousin, or I'm about to make a loan to some friend of mine. And I know you said that historically those things don't work out, but I know my cousin really well. I know this friend really well. They're going to take care of me. They're good people. Fair enough. We process the paperwork. I'm not going to talk you out of it. Again, we have to stay in our lane. We're just the administrator for the account. Unfortunately, and this is I'm wrong a lot in life, and I fully acknowledge that. This is certainly a situation where I strongly dislike when this works out the way I just kind of talk about it from a macro perspective. I cannot tell you how many times over the years people will come up to me years later and say, I don't know if you remember, we talked years ago, I lent money to my cousin, for example, and my cousin never paid me back a penny. They've stopped coming to family, get-togethers and what have you. And that's heartbreaking on every level. I mean, not only did that client lose what could be a significant portion of their wealth, but then also just kind of the human component, the loss of kind of a relationship with a family member or a friend, whatever the case may be. So long story short, unsecured notes, I've certainly personally made the mistake a number of times actually in my early investment career. I trusted the wrong people, took those hits, and investor beware there. I'd say the other thing is investing in complicated opportunities that you do not understand. So the private equity world is a little bit tricky. I would say the clients that invest into complicated technologies or these very confusing business models where it's some sort of private equity something, we invest in every asset class under the sun, and we're going to be able to get you a 20% return on your money and this, that, and the other thing. Again, unfortunately, historical data dictates that the more challenging it is for the average person to understand what the business is about, the less likely it is that the business ends up doing well. Because think about it this way: I'm not a very sharp human being. I will just leave it at that. I'm not the brightest crayon in the box. And my feeling is this: if, as an investor, I don't understand what your product or service is, it will likely be very difficult for the potential consumers to also want your product or service if they don't understand what your business or service is as well. And so if it is just too complicated and it's just too what have you, then that's going to be tough. It's going to be tough to make money. I also find historically that when it's super complicated, and especially again when you're placing monies with a group of superior human beings that are going to be able to get these incredible long-term returns with tens or hundreds of millions of dollars under management. There's only a few Warren Buffetts in this world, and unfortunately, the probability is that it's more likely to be something like a Ponzi scheme than Warren Buffett. And I cringe when I say that, because anything can be accomplished when people are laser focused and they're extremely talented in whatever it is that they're doing. But again, the question was just around, I believe, safe investments. And so I would say those things are not safe investments. So if you understand real estate, invest in real estate. If you understand stocks, obviously we're not the best fit for you, but you can certainly do incredibly well in the equities world. I think really just investing in what you understand, kind of the old Peter Lynch idea of invest in what you know. I think that's always going to hold true. Not to say you can't get lucky with a Dogecoin or a Bitcoin or something like that. Hopefully you sell near the top and changes your family's financial trajectory and what have you. But for most of us, it's trying to stick with the blocking and tackling. So anyways, love to get some feedback from you guys. If this was something that was interesting, if this was not something you want us to repeat, whatever you have in terms of thoughts on this idea of a Q&A session, we'd love to get some feedback from you. For those listening to us live, our next webinar will be April 28th. So it's Growing Wealth Tax Deferred and Tax Free. This is our fundamentals presentation. So for those of you that are new to self-direction, if some of the questions that were being thrown out today were a little bit over your head and your knowledge level, that's okay. We've all been there. And so this fundamentals webinar will address a lot of the stuff around prohibited transactions, disqualified persons, things of that nature. So again, thank you all so much for being here today. Love to get some feedback from you guys, and hopefully we will see you at a webinar soon. Thanks so much. Have a great day.